Got it. Cool. So hey everyone, thank you guys so much for joining. I'm Skyler Fernandes, founder of Venture University and VU Venture Partners. So I'll be going over a quick overview on the program. I'm going to go over the mini masterclass, as well as the general masterclass that we have in our main program. And if you guys have questions along the way, we can keep going. And just for time wise, do we have the whole hour, or just how long do we have? I just want to make sure I.
We do have 1 hour, Sky.
Cool. Awesome. So a little fun kind of quote to start off. I was like by Jay-Z, which is, "They've read a bunch of words, I've lived a bunch of life," which I think sums up a lot of the world of how you do venture capital and private equity and angel investing. Is that you can read a lot of books on how to do venture capital. You can take classes, and even for whether you want to be an entrepreneur or a VC, you can do a lot of reading, but you really just have to start doing it to really start learning. And when you think about the world of venture capital, there's a great quote saying at its core, venture capital is truly an apprenticeship business. And I think that's true both for entrepreneurship and venture capital. And so really what VU is offering is really a way where you can actually start learning by doing, and not just by learning. And I think that's the most critical thing that's different from us versus other programs, is we're significantly well beyond just academics. In fact, about 80% of what we do is not academics, is actually just doing the role of a venture capital investor investing in startups. So for those that are unfamiliar with Venture University, it's the world's leading investor accelerator for venture capital, private equity, and angel investing. I launched it about 3 years ago. The concept of an investor accelerator never existed before. There's obviously the concept of a startup accelerator where you learn how to accelerate your startup, but there's never been for something where you can actually learn how to do venture capital, private equity, and angel investing by actually doing it. So Venture University is an opportunity for people to actually join a venture fund and make investments throughout the year. Good, yeah, it's a good. Thank you for that quote. I'm a big fan of the Jay-Z quote. So we designed Venture University for a handful of types of individuals. And so we created one for people that are looking to join as analysts, associates, principals, and partners at venture capital and private equity funds, but it can also be used for people that want to launch or join a startup studio where you're creating companies from scratch, where you're developing the idea, you're hiring a team, you're starting to actually build the initial product. So really for people that want to do startup studios, startup accelerators, or corporate venture funds, where you're looking at either joining a corporation or you currently work at a corporation and you want to launch the venture fund within that company. Third big bucket for why people do VU is those that are angel investors and family offices, really looking at professionalizing their direct investment strategies. Maybe they've made a few investments in startups, but they really want to professionalize how they're doing that. They may want to become LPs in venture capital funds or private equity funds, or they may even want to go and just launch their own fund. So we help everyone figuring out, how do you actually go and create your own fund entity, and how do you start investing in startups? We kind of show everyone the process of how to actually create what I'm calling a minimal viable fund. Just like startups have minimal viable products, we kind of coined the structure of a minimal viable fund entity, which is something that we've innovated on, of how to create actually a very low cost, streamlined legal structure to be able to create a fund that won't cost you $25,000 or $100,000, but can kind of get you going with an SPV. Fourth category we created it for is for emerging fund managers. About 30% or so of the people that do Venture University are emerging fund managers, so they're looking to launch their own fund. Fifth is kind of industry experts. Maybe you've been in an industry for 1 decade to 2 decades, and you're now looking at transitioning your career into the world of venture capital or private equity, where you know markets really well, you know how to do due diligence on certain spaces, and you would be a really value add on a venture team focusing on that space. So industry experts are certainly a big category. Next is entrepreneurs and founders. These are probably some of my favorite people joining Venture University. Individuals who have potentially even sold their companies, where you have people that, started a company, a handful of years ago. They sold the company for a decent amount of money, and now they're thinking about launching their own fund or joining a fund. Or one of my other favorite categories is they're looking to figure out what the next startup is that they want to start. And I think one of the biggest weaknesses of founders is founders typically start the first company that they think of. And they don't usually have like 50 ideas that they're competing against to figure out which of those 50 ideas is actually the biggest market opportunity and the best to execute on. Most founders come up with like one or two ideas and then they go and start that, which is really putting most founders at a big disadvantage. But I think serial founders who have started a company before, they're a lot more mindful about what is an actual big market opportunity. Because a lot of founders, they just kind of think every market's a big opportunity, and they don't really understand the scale difference of what a really, really big opportunity is versus a smaller opportunity. So doing a program like Venture University, I think, helps ground you with actually understanding scale of when is big actually big, and when is something big enough that a venture fund might actually finance it. Otherwise, it might just be a lifestyle business. So I think the value of founders and entrepreneurs doing Venture University is actually great. I think we would have much more successful founders if more of them had a real basis in understanding how venture capital works and how do you scale a company that could be worth $1 billion or more. And then lastly, we created Venture University for really select undergraduates and graduate students that are really looking at breaking into the industry. If I look at out of the 100% of people that have done Venture University over the last 3 years, about 50% of them are people that want to join kind of as analysts, associates, and principals. And the other 50% are really broken out amongst these other categories. And then from an age perspective, we have people in their 20s, 30s, 40s, and 50s. And we almost have an equal quantities of roughly 25% in their 20s, 30s, 40s, and 50s. So it's a pretty diverse group. It's not for just people coming out of college. That's actually the minority of people are the ones that have just come out of college. Most people are career professionals and have anywhere from 5 years to 20 years of work experience. So kind of the mini masterclass that's coming up that we have scheduled later in October, we're going to cover a few core things, and it's designed as a mini masterclass. So it's not going to cover what our traditional masterclass has, which is a lot more inclusive, but we try to tailor this specifically for entrepreneurs that would be joining. And so we're going to cover a few core things. We're going to go over market size and opportunity of how to know how big an opportunity actually is, and how to know when an opportunity is big enough for a venture fund to invest in it. But I think really getting a sense of how to even calculate your target market size and understanding the difference between TAM of target addressable market versus SAM for serviceable addressable market and SOM for serviceable obtainable market. So we're going to go over kind of really just understanding markets and what is actually your target market or what could be a target market that you're going after. One of the fun parts of that exercise is we've kind of coined a new phrase. We have an article coming out soon, which is how to create a company that theoretically could be worth $1 trillion or more, which is a fun kind of mathematical exercise. Is everyone's kind of going after these unicorn companies. And I would argue that you really have to look for above and beyond unicorn companies to actually get a unicorn. So being able to actually mathematically understand how could a company be worth even $1 trillion, which we now have about 5+ companies now that have reached $1 trillion valuation. And we're calling those companies chimeras versus unicorns. And chimeras are not as cute and fun looking as unicorns. They're this kind of massive, ugly looking mythical creature. But we think it represents kind of what a platform is. And I think having people understand what the difference is between a chimera potential versus a unicorn potential is critical. Someone asked if I invest in a Venture University fund, how much say to any of the investment decisions being made? Yeah, so if you join Venture University, the full-time program, everyone has a vote in the investments that we're making. As we'll get more into the details, we invest in about 2 to 5 companies a quarter. And so everyone that's part of the cohort is part of the investment committee. So you'll absolutely be able to decide and help be part of the vote for what we're investing in. What I also say is you're going to have complete control over bringing a deal to the investment committee. It just requires one person's conviction to bring a deal to the investment committee, which is also really empowering and pretty much unheard of with any other, even if you were at a traditional fund, is almost unheard of. So at VU, we just require one person's conviction to bring a deal to the investment committee. Do you think investing in startups is directly related to the power law? Should VC look for home runs? Correct. Yeah. In general, it's very much you have to go for really, really big opportunities every deal you're doing. I'm not going to go too off course on the script because I know if we get into a lot of these questions, we'll be here for many, many hours and it goes beyond the scope of this talk. But But to answer your question pretty briefly, yeah, the power law is 100% in place. Every deal that we invest in has to be 10x or greater. And ideally, every investment we make has to be able to return the entire fund, or at a minimum, return about a third of the fund for every investment we do. So if we do at least three winners, we would return the fund, is the play. But ideally, at least every deal has the potential to return the fund. As we go into, after talking about market size and opportunity, we're going to go over evaluating teams. We have kind of a rubric for how we evaluate teams at all different stages, and what we're looking for from those teams. So team is certainly super important because teams execute. And so we do have an actual way of evaluating teams. It's not just a warm and squishy feeling kind of way of, do I like the team or not? We do have a way of evaluating teams. Third, we're going to go over traction and key metrics. What are the things that we look for with regard to key metrics? What are the things that matter of how we're evaluating the company's success so far? And it doesn't mean you can have key metrics that don't mean revenue. So there's a lot of key metrics that are not revenue based, but are showing still traction and progress of what you're doing. So we go into really evaluating traction and progress, both pre-revenue and pre-product, product revenues and forwards. So all different types of kind of key metrics that you're looking at. One of my favorites is looking at how to understand capital efficiency in companies, which is something that I think a lot of venture funds don't probably do very well. Is evaluating teams directly proportional to pedigree? No, I think if you look at there was a report done a few years ago of evaluating all the unicorns at that time, and the vast majority of them did not have MBAs for one. So most of them didn't have MBA degrees. Most of them didn't go to necessarily Ivy League schools. And so it really comes down to understanding the market opportunity, as we'll go over, as well as even understanding things like the unfair and sustainable advantages matter much more than pedigree. Can I find funding from a scale? I have no clue about your business that does pharmaceutical manufacturing, but again, that's part of the value of doing a class like this coming up, where you would learn that answer. So going over unfair and sustainable advantages, a lot of founders, I don't think, have a good appreciation for all the different various types of unfair advantages and sustainable advantages that exist. And so making sure that you're building a company that kind of has a handful of those to increase your success, not only in the short term, but increase your success for the long term to ultimately win an industry. And so, technology itself is probably one of the weakest types of advantages. And also, saying things like you have first mover advantage. I hate when founders say I have first mover advantage, because there's almost no company in history that's ever won that had first mover advantage. Pretty much all the winners are fast followers that have shot the first mover in the back and then ran past them. So we go over a lot of kind of things of how to actually create more of a sustainable advantage for a company. And I'll tell you just from the get-go, it's not technology. And there's a lot of other ways that you can build more meaningful advantages than any kind of technology you're going to build. And those kind of things tie more to business model and strategy. And then lastly, talking about who your investors are, both at the early stages and through the growth stage. It's really important to think about who you are bringing onto your cap table, the quality of those investors, and how they're going to be able to be value add to you beyond just the capital they're providing. And so we go into a handful of kind of how an investor can be value add, and how to actually test an investor of actually if they're going to be value add before they even invest. One of the things I do, and I've been doing this for over a decade with the companies that I invest in, is I always show that I can be a value add investor before I put any money in. And then I can kind of amplify that even further if I actually end up investing. And then lastly, kind of tying into what the return opportunity is how do you actually calculate the return opportunity that investors would be getting from investing in your company, and getting an idea of what that means for you as a founder, of how much money you would get, and how much money an investor would be getting at different stages of their investment. When evaluating teams, is disruptive early stage startups, how much weighting do you give the founders versus the entire team? Well, at the very early stages, there is the entire team is the founders, so it's kind of the same thing. There's not much, like the org chart looks very small. It's just like 3 to 5 people. So you are just mainly evaluating the founders. At the end of the day, the buck always stops with a few people. Not everyone's equal. And I think that's an important thing to realize at the very beginning is not everyone's equal in skill or importance. And so I care a lot more about who the people are that are going to bring this company forward versus the entire team. Also, having like equal ownership is never usually a good idea. I know it sounds good, like, oh, we're all going to have a third of the company. That's never usually the right decision. So we go over also, what the right kind of split on equity is for founders, because some people definitely matter more than others. And if you just don't like that idea, I'm sorry, but that's the reality of things. And if you start off with thinking everyone's equal, you're probably going to fail. We are a product development company. Revenue generated has not been made, but looking for us. I have no clue until I learn more about your company. That's way too short of a description and silly to even ask a question like that because I would not know enough information to give you an appropriate answer. All right. So now we're going to jump into kind of beyond the mini class, what you would be looking at. Beyond the mini class, we have the ability of doing the Investor Accelerator, which is really our main program. So the main program is inclusive of a few things. It's an 11-week program. And it includes a VCPE apprenticeship program where you are joining an actual venture fund to go along our side of our team to work with us in deal sourcing, doing due diligence, and actually making investments. Any guidance on crowdfunding? Usually it's for weaker companies that can't raise traditional venture financing, unless you're a consumer company or using it for marketing purposes, would be my general thought around crowdfunding. But it's usually your second option, not your first option, unless you're a consumer-facing company and using it for a marketing play. For beyond the core VCP apprenticeship program, we have a profit-sharing agreement that we give to everyone where people have a share of the upside in all of the investments that we're doing. So you have the ability to actually get back some, all, or more than the tuition of doing the program.